The Smarter Money Life podcast is sponsored by Forum Credit Union, a member-owned financial cooperative serving members since 1941. Forum, your trusted financial partner, helping members live their financial dreams every day. Hello, everyone, and welcome to another episode of the Smarter Money Life podcast. I'm Andy Mattingly.
And I'm Nicole Royal. Today we're talking about something a lot of people stress over, buying your first home.
Yeah, it can feel very overwhelming, but it doesn't have to be. We're going to chat through the biggest myths, what you can actually focus on, and a few don'ts that can save you from serious headaches.
Pretty much everything we wish first home buyers knew before diving into their home buying process. To help us, we're going to be talking to a friend of the show and previous guest, Mike Senn, Vice President with Forum Mortgage.
Mike, thanks for joining us today. You've been a popular guest with our listeners, so we're glad you're able to come back and join us again.
Thanks for having me, Andy. It's good to be back.
All right, Mike, we are going to start by busting a few myths. Let's start with the classic. You need 20% down. People treat this like it's written in stone somewhere.
Yeah, 20% as a required down payment is a common myth. I mean, that was a thing decades ago, but mortgages have really evolved since then. Depending on your credit and your income, you can buy a house today with a down payment as low as 3 to 5%. In some cases, there are programs that a borrower can qualify for 100% financing today, given they meet like certain income limits, etc. There's a lot of loan programs out there for buyers right now.
Next one, which seems simple and it's subtle, but it has major consequences. Pre-qualification and pre-approval are basically just the same thing.
Yeah, there is a big difference between the two. So let's talk about each. Pre-qualification, it's just a basic information review. They talk about income, assets, and liabilities, but there's no hard credit pull, no underwriter review. It's just a high-level scenario and a number crunch. Not very helpful, but it's a step, right? But pre-approval, on the other hand, it's a little bit different. It's a little bit more official. We do a full loan application, a deeper dive into the income, assets, and liabilities. We are going to pull a tri-merge credit report on each borrower. And then we take that information, we submit it through an automated underwriting system. And then again, we put it in front of an in-house underwriter for review. So it's a very thorough review to make sure that the borrower understands where he or she can start and stop in qualification. But most importantly, we issue a pre-approval letter. And that pre-approval letter tells the realtor and the seller that they're prepared and qualified to buy a house. So if you really want to buy a house, you're going to need this letter.
Here's another one that's always a little tricky. An appraisal replaces an inspection.
I'm glad you brought this up. Yeah, they are very different. An appraisal is ordered by the lender and is used to confirm that the agreed purchase price is in line with market comps. This is a very important step in the loan process. Home inspection, on the other hand, is ordered by the buyer, and that typically happens shortly after they go under contract. This is a deep dive inspection of the property's condition. It points out any red flags. A home inspection, it typically lasts maybe like 2 to 3 hours. I mean, the guy's in there for a long time. And then when he's done, he gives a report that points out any concerns, big and small. You know, although a home inspection it's not required by the lender, it is highly recommended. So, I mean, it can save a buyer thousands, not to mention peace of mind.
Yeah, that's a really good point. Okay, here's another myth. Let's talk about lenders. You should always choose the lender with the lowest rate because that's all that matters.
Yeah, this one's tricky, Andy. You would think that would be the case. The lowest rate wins, right? I mean, but not all lenders are the same. Some lenders charge high fees. They have different loan programs. And some lenders don't even service their loan after closing. So you really want to do your research on the lender that you are going to select, because you want to make sure that not only you understand their pricing model and what their process is, but also what is it going to look like after closing. It's a really important decision.
This is one of those concerns that really generally concern younger borrowers. You have to have perfect credit to get a mortgage.
Yeah, perfect credit? No. You don't have to have perfect credit, but you do need to have responsible credit and a history of paying creditors back on time. You shouldn't have any recent derogatory accounts or outstanding collections. Nicole, a good rule of thumb is the better the credit score, the more options you're going to have, right? So like generally speaking, a borrower should really try to have a credit score of at least 680 or greater to have a good array of loan options. However, in some cases, borrowers may be able to go as low as 620 and still get a loan. So it really depends. But that's why taking the steps early to get pre-approved is really important. So you can take time to review and address any issues that might pop up in credit hurting your scores.
Now, this is a myth that I hear quite often. PMI, or private mortgage insurance, is always bad and you should always avoid it.
Honestly, PMI is just really misunderstood. It's actually very useful, but it's a trade-off. Yes, if you have PMI, it's going to be an additional fee in your mortgage payment, but it also allows you to put less money down on the house instead of putting down that magic number of 20%, right? PMI has helped thousands of buyers get into a home with a low down payment. But the nice thing is you're not going to have PMI forever. It can be removed once you hit 20% equity in the house.
Okay, our last myth to bust. Once you are pre-approved, you're locked in and will always be able to close.
That's definitely a myth. Being pre-approved is just the start. There are other steps to go through. So, once you go under contract to purchase, there's a home inspection that needs to get done. On our side, we're going to need to update your loan application, discuss locking the interest rate with you, order the appraisal, title, and then everything goes into an underwriter for final review. Once you have a final loan approval, that is when you can go to the closing table. So it's definitely a process.
Okay, Mike, let's shift from busting myths to just having you share some of the important items that all first-time home buyers should understand. So I'm going to start with, what is debt to income and what are lenders looking for in this ratio? If you could explain to our listeners.
Yeah, for sure. Well, to keep it simple, debt to income ratio is basically how much money's coming in to how much money's going out. Okay. So generally speaking, lender guidelines typically want to see you be at 45% or less using your gross monthly income towards liabilities. So those liabilities, there's going to be like your entire mortgage payment, including an HOA, any auto loans or installment loans, student loans, any minimum credit card payments. If a borrower is paying child support, we'll need to include that as well. Andy, one thing to note about debt ratio is lenders, we're using a borrower's gross income to qualify and to come up with that ratio. Debt to income ratio itself is not really a perfect tool for a borrower to use to determine if they can truly afford the house. So understanding their monthly budget up front is really key when deciding on a home.
Here's one that I think is always confusing because it's not part of the down payment. That is closing costs. What are they and how much can they be?
Yeah, I'm glad you brought this up. It does get confusing. And in addition to down payment, there will be other costs when buying a house. Let's talk about closing costs right now. These are any costs associated with getting the loan done. Credit report, appraisal, the lender's fee, title insurance, closing fee, recording, etc. These fees will be different with every lender, so it's important to shop around. Depending on the loan amount and loan program, closing costs can range in price, but let's just use $2,500 as an average, and that's without doing a rate buy down. Okay. The next set of costs are called prepaids. Prepaids consist of a full year's homeowner's insurance policy, plus 2 months of the property taxes and 2 months of the homeowner's insurance to set up an escrow account. This is going to be the same with every lender. So that's not going to fluctuate because it's all about the property and the policy. Prepaids on a home, that could range anywhere, between $2,000 or even higher. Depending on the property taxes and homeowner's insurance, that's going to kind of push that up. So you can see it all adds up. But what we have seen, Nicole, is that a lot of buyers today are actually negotiating that the seller pay some, if not all, those costs inside the purchase agreement. So, that's something that if a buyer is short on money, they just have the down payment, but they need help on the closing costs and the prepaids, they really want to talk to their real estate agent about it, about including it in the offer.
Can you give our listeners kind of a high-level overview of the major steps in buying a home? Because you hinted at different things there. So could you help them walk through like some of those steps and who they need to talk to and things?
Yeah, I think the most important step, Andy, is in buying a home. Honestly, is really just establishing that relationship with the lender up front to get a pre-approval. At that point, that mortgage advisor is going to be able to guide them through the home buying process step by step and establish their target home price, picking the right loan program. The right lender is going to help you navigate, and they can connect you with getting a realtor after they've gotten you pre-approved. They can be kind of serve as an advisor with any questions or just try to help you take those steps. So it's a process, but it all starts with the lender.
I think those are great first steps, Mike. Do you have any closing thoughts for our listeners that you would like to share?
I would just suggest, I guess, to the listeners is start the home buying process early. No matter if you're buying your first home, you're upsizing because your family's growing, or you're downsizing for retirement, get all your ducks in a row. Like formulate a plan so you can shop and buy a home with confidence. It all starts with connecting with the right lender, and do it early.
Well, Mike, thanks again for joining us. You always have great tips, and I know you and your team are always available to talk to any first-time homebuyer. I know we've both sent a lot of people over to you through the years, and we really appreciate that. So thanks again for joining us.
Thanks for having me. Always a pleasure.
All right, Andy, it's time. The part of the show where we talk about all the things that blow up people's loans.
Yeah, the don't do this list. Number one, once you've got a pre-approval, don't open new credit. No new credit cards, no new car loans, no 0% interest furniture deals to put in that house. Just don't open anything.
Here's a good way to think about it. If a cashier says, would you like to save 10% by opening a card? The answer is always no.
Exactly. And don't change jobs without talking to your lender, especially if you're switching from W-2 to a 1099. That one can stop everything.
Also, no big unexplained deposits. Lenders are like detectives. They want to know where your money comes from.
And please, get your homeowner's insurance early. Don't wait until the final week. It may take your company a little bit of time. Plus, you may want to shop some different ones to get the best deal. So get your homeowner's insurance set up early because you don't have to pay for it until it starts.
All right, let's do a rapid fire tech list. Ready?
Okay, I'll start. Pull your credit reports and clean up anything weird.
Get a real pre-approval, not a pre-qualification.
Decide on your maximum monthly payment. And we heard Mike say that. Not just what you're approved for, but what you really feel comfortable paying, which is probably different.
Look at total monthly costs for each month, not just the mortgage.
Choose a buyer's agent who knows your neighborhoods that you want to move to.
Get your inspections scheduled immediately after your offer gets accepted.
And review your closing disclosure early. Don't rush that part.
Okay, that's our guide to surviving and thriving during your first home buying experience. If you need more tools or information, just head over to forumcu.com.
And don't forget to tune in next time for more ways to make your money work smarter for you. Thank you for joining us today. Our hope is that we can help you live your best financial life. For more insights, be sure to subscribe to the Smarter Money Life YouTube channel and also catch the Smarter Money Minute segment every Thursday on Fox 59's Indy Now Lifestyle Show. Remember, reaching your financial dreams is a journey, and every step you take brings you closer to making your dreams a reality.